All right, it's time for me to welcome Narendra Kumar, the CEO of Value Research. Narendra, thank you so much for coming in. Before we move on to answering the questions we've received, I want to talk to you about the RBI rate cut. Now, for those of our viewers who are not familiar, on Tuesday this week, the RBI cut interest rates by 25 basis points. This is the third time this year. But it also said that there's very limited room for future rate cuts because of the risks of inflation. So banks have said that they will start reducing lending rates, but besides that, the message that we might not see further rate cuts for a while sent stock and bond prices tumbling. So, Narendra, one of the things we should worry about here is those of our viewers who've been investing in fixed income funds. What sort of an impact will this have on their returns for the rest of the year? Because I know there were a lot of investors looking to play the interest rate cycle. Is this bad news for them?
You know, there was a virtual consensus that rates are going to come down sharply or regularly in times to come, and that has been, put on hold for a while. Of course, rates will come down, but will it come down in a hurry as expected? It is unlikely to happen it's unlikely to happen that way. So my sense is that most investors who are into fixed income funds, not necessarily into income fund or the dynamic bond fund, who are trying to capitalize on the rate cuts, they stand to benefit, because what we see here is returns close to 10%, inflation coming down, so they becoming real return positive, which I think is great news and which is the objective of RBI in the short run. And the wait will be longer. But I think, apart from that, investors must look at fixed income fund, or larger investors who pay taxes. They must look at fixed income funds with a long-term perspective, and more so because of the tax change, the taxation rules which change, that you have to hold it for 3 years to be tax efficient. Then only they will be eligible for indexation benefit.
We normally recommend that you pick a fund based on the time horizon that you have in hand. But if you have more questions, feel free to get in touch with us. Our email ID is at the bottom of your screen. Let's move on to our portfolio question. Sridhar has written in from Bangalore. He's 31 years old, Narendra. Both he and his wife are software engineers, and they earn together about 91,000 rupees a month. Now, here's the good news. They're expecting a little baby in 3 months' time. Congratulations to both of you, Sridhar. Now, he sent us a list of his goals. He wants about 3.5 crore rupees after 29 years for his own retirement. He also wants to put aside close to 1 crore rupees for his child's education and wedding, which will possibly happen in the next 18 years. This is a baby who's not born yet. He sent us a list of his financial details. He saves about 50,000 rupees a month, Narendra. There's 24,000 rupees going into a PPF. He has health insurance and he has several life insurance policies, which we'll get to in a bit. He has about a little over 2 lakh rupees in a savings account, and he has 50,000 rupees in a fixed deposit. These could be his emergency fund. He also has some sort of SIPs going in as well. There's some investment in land and, of course, the LIC policies. His first question has to do with life insurance. Now, while he's considering getting what I think is quite an adequate term insurance cover, he does seem to have a lot of ULIPs that he has bought. He wants to know if it makes sense to surrender this and what the best process would be. Now, obviously, we would like him to first get the term insurance policy. So we don't want any sort of gap between you surrendering one policy and getting another. Once you get your term insurance policy, Narendra, what's the best way to exit the ones that he already has?
Just be methodical about it. Don't exit your ULIPs or endowment policy in a hurry. Take your policy document out. You would have never gone through the fine print. Find out the surrender charges, and at different periodicity, after different period of holding, the surrender charges come down dramatically. So plan it, though your investment or your selection of ULIP may not be methodical, at least the exit should be very methodical. Get into the details, and yes, one should get adequate term cover, and buying online might get you much cheaper ones.
Well, Narendra, he's planning on also buying a health insurance policy, and he wants some advice there. Well, it does seem like you're getting 5 lakhs as a cover. That's good. I'd recommend about 15 lakh rupees, especially if you're living in Bangalore. But my only advice to you would be, if you're planning on having another baby sometime in the future, 2-3 years down the line, buy a policy that also covers all maternity costs and the birth of the other baby as well. Right, back to us if you need help on that. But Narendra, let's take a look at his mutual fund investments. Now, he started investing in these funds and he's sent us the list. He has Access Long-Term Equity, Reliance Tax Saver, iProof Focus Blue Chip, Franklin India Smaller Companies, Birla Sun Life Frontline Equity, L&T in India Special Situations. It does seem like a good solid list. Would you like to make some changes there?
Carrying on with this portfolio is good, but he should be a little more focused in terms of maximizing his investment at this stage when he has all the time, because compounding will work to his advantage. If he is allocating his money in the most productive asset class at the outset, which is at this stage, because he has a lot of time on hand. So optimizing it at the outset means possibly discontinuing his contribution to PPF, because that is a long-term fixed income investment. And when he has chosen, when he has got used to SIPs, it is fairly straightforward that on a 15-year basis with your regular investment, the return on your SIP is likely to be substantially more than PPF. And anyway, you are not compromising on your fixed income allocation. You have your emergency fund, you have your fixed deposit as well as the money lying in the savings bank. Keep it handy. Keep that much of liquidity. But your EPF is also a fixed income allocation, and that is something which is not negotiable at this stage. So maybe continue your EPF, discontinue your PPF, and the money which you will be realizing by discontinuing, or the money which you will freeing up by discontinuing your ULIP and endowment policy should also find its way here. And these 6 portfolio makes it an excellent diversified portfolio.
You also sent us a note saying that you're planning to take a home loan of 20 lakh rupees for 6 years with a monthly EMI of 37,000 rupees. That does seem like it fits into your surplus cash right now. So it seems fine. I don't see any reason why you shouldn't take that home loan. Like Narendra said, if you do free up the cash that's going into your PPF and to your insurance policies alone, that will give you an extra 80,000 rupees a year that you can, channel towards your mutual funds. And like we always say on the show, as your salary increases, which it will, make sure that you increase your contribution to your mutual funds as well. Make sure also life insurance for both you and your spouse, considering you all are both working. All right, before we go into our quick break, as you know, last week we started a brand new segment called The Beginner's Guide. We told you how you can start doing your KYC. Now that your KYC is done, we'll tell you how to buy a mutual fund online. All right, Krishna is here to tell us how we can buy a mutual fund online. Krishna, take it away.
Thank you, Faye. Last week we told you how to get yourself KYC compliant, and it's time now to get your hands on an SIP or systematic investment plan. These are days where groceries are bought online, so why not a mutual fund? One of the simpler ways to invest in a systematic investment plan or SIP online is to log on to the website of a registered distributor. On this particular website, all you have to do is give your name, email ID, mobile number and generate a password and you're good to go. Once you're done logging in, all you have to do is select a mutual fund where you want to systematically invest in based on the kind of returns you'd like. And then type in how much money you would like to allocate on a monthly basis. Remember, you can start an SIP for as low as 500 rupees. And once you're done doing that, all you have to do is wait for a call from your mutual fund distributor, who will also send a representative to your premises. And once the representative arrives, all you have to do is give your CVL number for your KYC compliance and the first check for your systematic investment. All said and done, make sure you get some proper professional advice before you choose the mutual fund where you want to have an SIP in. And remember, it's always better if you have an investment account with a distributor so that you can purchase all your future SIPs through your Demat account. With that, it's back to you, Faye, in the studio.
All right, so that's how you can buy a mutual fund online. And if you want advice on which mutual fund to buy, that's what we're here for. Welcome back. You're watching Investor's Guide in ET now. Thank you for staying with us. It's time for our product review. This week we're looking at the Franklin India Taxshield Fund. Avan will take you through the numbers and then we'll ask Narendra whether or not we should be using this fund for this year. Avan.
Thanks, Faye. Under focus this week is the Franklin India Taxshield Fund. It was launched in 1999 and has an impressive long-term track record, giving returns of 26% since then. The fund has underperformed the benchmark only 4 times in its existence of 15 years. It doesn't stand out on the performance chart in a rising market, but it clearly stands out in a market downturn with its ability to restrict its fall compared to its peers. The fund focuses mostly on large cap stocks and ignores momentum stocks. Its large cap bias, however, doesn't prevent it from picking small and mid cap stocks with long-term growth potential. However, the fund's focus for concentrated and contrarian bets can expose it to above average volatility. The fund has beaten both its peers and the benchmark in the 1, 3, 5 and 10-year periods. In the last 1 year, the fund has given 33% returns, while its category average 24%. So should this feature on your portfolio? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. Narendra, such stellar numbers on this fund, and for so long, it's displayed its consistency, it's displayed sound fund management. I like the fact that even over 10 years, it's the #2 fund in its category. Is this really the textbook definition of what we should be using for our tax saving over the long term?
Yes, right now this fund looks very impressive on the long-term basis. But when you look at, shorter time period, 3-year, 5-year, on many occasions, there are many other impressive funds to look for. But what I like about this fund is not its numbers alone. What I like about this fund is its focus on quality, its ability to withstand a market decline, never getting distracted from its basic, approach to investing its money. So that is what is that is something which makes me recommend this fund on many occasions when it is not backed by compelling numbers on a medium-term basis as well. For anybody who is getting started, first time investing with a tax-saving fund.
But Narendra, I'm looking at again the numbers on your website on Value Research. It's very interesting. The top holdings of this fund: HDFC Bank, ICICI Bank, Infosys, IndusInd Bank, Yes Bank. A lot of it is financial and technology. But the interesting part about it is, a lot of it has not changed since the 30th of April, which is the last time this list was put up, which means that even while, you're talking about the fund management, this is a fund manager who doesn't tweak with his portfolio too often. So if I'm someone who's looking for a long-term view, is this the kind of fund management I want?
Yes, absolutely. A great fund should also be able to, buy funds to buy stocks to hold it for the long term, and his expectation should materialize. And that apart, I don't think a high turnover in a fund portfolio is a impressive thing. Normally, a good fund manager, most good fund managers I've come across, they buy stocks for a reason. They buy stocks at an attractive price and they hold it. And many a times, the opportunistic component, the component of their portfolio which needs to be churned because they bought it low and they will be able to sell it high quickly, that doesn't happen. Most fund managers actually make most of their money by holding great stocks for a long time.
All right, on the merit of its consistency, the purity in the fund performance, and of course the numbers, Narendra, what rating would you give this fund?
I'll give it a 5-star fund for anybody getting started with their tax-saving investment.
All right, 5 stars there for the Franklin India Taxshield Fund on Investors Guide. Remember, 5 stars is not easy to come by on this show. We're fairly strict when it comes to our reviews. So if you have questions about that fund, feel free to write to us. Our email ID is at the bottom of your screen. Very quickly now, moving on to our hold or sell segment. So 46-year-old Manohar has written in, Narendra. He tells us he's an NRI and he's been investing in Indian mutual funds from December last year. Now, his goal is to save for his son's education, and he's going to need the money in the next 7 to 8 years. And he'd ideally like to get a return of at least 10% annually on his, on his investment. Before we get into the mutual funds that he's picked, 10% annually on an investment in an Indian mutual fund over 9 years, that's not a very heavy, ask. That's something that the mutual fund should be able to meet easily, isn't it?
One has to look at it from his perspective. He's an NRI. The interest rate, prevailing there will be substantially lower. 10% return could be high. And he has to look at, his currency denominated return. So he will be remitting his money. That gets converted into rupee, gets invested into these funds, and the rupee depreciates over time. He will be, if he is going to take that money back, that money, the 10% return, or whatever be the return in India, it won't be his return. His return will be lower than that. But despite that, today I would keep, conservatively put it at about, 16-18%.
Well, if you look at the list of funds that he has, Narendra, there are, it seems to be haphazardly put together. I don't know why, but he's put 1.5 lakh rupees into close-ended funds. He also has mid-cap funds, frontline equity. He has the Sundaram Smile Fund. It does seem like he was chasing performance a little bit. Would you be happier if he invested in our aggressive portfolio instead?
His fund, all of them put together, is a compromise on diversification. It's full of the mid caps, and the last two fund where he has invested 1.5 lakh rupee each. That's not a liquid money. It's a compromise on liquidity as well. That is the money which is not accessible to him. These are investments which are best avoidable, because important thing for an investor is to be able to average his investment. So his advisor is not doing a good job. He should be investing regularly. Choosing our aggressive plan will be more useful, and it will be he should be disciplined about investing regularly, and that will be a superior diversification way of diversifying.
All right, so that portfolio is on your screen right now. Feel free to get back in touch with us if you need anything else. Narendra, one very quick question before I let you go. Abhishek has written in. He's 34 years old. He has a 2-year-old daughter, and he's looking to save for his daughter's education. He's been investing in the ICICI Prudential Life Maximizer plan for the last 9 years and the LIC Guaranteed Returns plan for the last 4 years. He wants to know if his strategy is prudent. So he is getting some amount of equity through these plans, but they're not the most efficient way to do this. I mean, if I'm investing for the next 18 years or 16 years, should I be using a guaranteed returns plan?
For this, he should first get a term cover, that if he's not around, his daughter is well taken care of financially. And then, look at term cover as your cost, and then the next step should be investing wisely in a regular, disciplined manner in a fund which has been consistent for you. And any money which you are disciplined with, investing with a purpose, investing with a time frame in mind, with a definite goal, and have the discipline not to take it out if you for consumption in the interim, is your child's plan, whether it be for the education or for the wedding or for any other goal. So don't get carried by the name. Don't get carried, be lured by this guaranteed and non-guaranteed. You have to take risks of some kind to optimize or maximize your return. Just have a very simple approach to investments, which is choose 1 or 2 good funds for your SIP. Start making your SIP for your daughter's need, and get a term cover before that.
Narendra, he's obviously someone who's a little bit conservative. If he's going to invest for the next, say, 16 years at least, would you be able to give him 2 funds that he can use?
If I have to recommend 1 or 2 conservative funds, I would say ICICI Prudential Dynamic Fund or the Quantum Long-Term Equity Fund.
All right, it's time for us to take a very quick break. Narendra, thank you so much for answering our questions this week.
Thank you.
It's a pleasure, as always, to have you on the show. Welcome back. You're watching Investors Guide in ET now. Thank you for joining us. We brought in Feroz Aziz from Anand Rathi to answer the questions you sent in on your asset allocation. Feroz, welcome to the show.
Thank you.
Our first question comes in from Mohit, who wants to know how the recent increase in service tax will affect his insurance plans. Will there be any difference at all when declaring and claiming the premium invested under ATC? Feroz, obviously not, but there will be a change in his premium, won't there?
Yes, service tax, a basic increase from 12 to 14% is not a very significant increase from a perspective of a term plan, especially because term plans are not those investments where you part with your money. The premiums don't have any return for that matter. Those are expenses. Now, even if you look at a 2 crore cover for a 35 year individual, you're still speaking about a 25,000 rupees premium. And 2% on that is 500 rupees. That's the impact on your premium. So you will be able to get a tax break on this 500 rupees. Incremental you will end up spending to get the same amount of cover. So then the hole in your pocket is not to the extent of 500. It's to the extent of about 2/3 that. That's about 350 rupees. So it's nothing to be bothered about. Even if you assume a 2 crore cover, you're speaking about a 350 rupees impact, which is not even a meal today. So I think so there's nothing much you have to be worried about, Mohit. I think this will have a very little impact, especially on term plans.
Our next question comes in from Vijay, who's 32 years old. He tells us up till now he's only been investing in tax saving schemes. He now wants to invest in diversified equity schemes. Now, he sent us a short list of funds. He wants to know if these are the right funds and in what proportion he should be making these investments. Now, it's very important, Vijay, that you also consider how much money you're going to invest in these funds, what goal you have in mind and how long you'll stay invested. But Feroz, could you help him out with what he should do next?
The funds you've chosen require a little tweak because all the three of them predominantly have a large cap portfolio. I would suggest that having one mid cap fund will actually bring in a super balance. If you're looking at a bull run, which is what we are in, and there would be some interim corrections of course in a bull run, mid caps have a large flavor because they become prospective large cap companies. It's like getting an Infosys when it was just born. So mid cap stocks being in your portfolio is very critical. What proportion in mid cap is a more important question to answer than just the proportion in these three funds, because all of them are large cap anyway. So you need one mid cap scheme. So I would swap one of them and I would buy myself a Franklin Prima Plus fund, which is a very good mid cap scheme, little largish kind of a mid cap, but I think you can go with two of those, which are the UTI Opportunities and ICICI Focus Blue Chip, and swap the SBI Blue Chip with a Franklin Prima Plus fund. This as a combination will complement each other, and 1/3 in each of them should be good.
Last question comes in from Narendra Tiwari. He's planning on investing 1,000 rupees in mutual funds every month through SIPs. That's a great idea. He has an investment horizon of 7 to 10 years. He wants to know what sort of fund he should be investing in. Feroz?
I would suggest you buy yourself an opportunistic kind of fund. To define it, I would say it can invest in large companies, it can invest in mid companies, it can also invest in small companies, because you have 1,000 rupees to start with. If you buy yourself an opportunistic kind of fund, you will get an exposure of all kinds of companies with your 1,000 rupees. So in that category, the best one which I would suggest would be a Reliance Equity Opportunities, so that you don't have just one category of companies. You will get most of them with your first investment itself. And as you scale up, then you can probably relook at the strategy of buying specific large and mid-cap schemes.
All right, that's a wrap on Investors Guide. Remember, you can get in touch on email, and better still, you can reach me personally on Twitter. My handle is at the bottom of your screen right now. I'd be absolutely thrilled to hear from you. Tune in next week to catch Investors Guide. Thanks for watching.